All right, so we've spoken about financial leverage and we understand that it magnifies risk and reward. But let's take a look at the effect of borrowing and why we may consider borrowing on our income statement, okay? So very quickly, we're going to take a very vague and general example into consideration here. Let's say that we have $30,000 to spend, right? So we have cash, well, let's say we start with $30,000. Okay. Tax in our country is 35%. Let's just say it's a flat rate of 35%, okay? That's very important. The tax rate. Interest rate, let's say borrowing from a bank, we'll say it's 10%. I think that's pretty reasonable. So again, for our very simplistic example here, all we need to know is that we are planning to spend $30,000, okay? We have $30,000. We have a choice. Either we make an investment with this money or we borrow the $30,000 to make the investment. So we can either use the $30,000 that we have to make an investment, or we can borrow $30,000 from the bank. So let's take a look. So we'll say the left side here is us using our own money. So let's just say equity. We'll just say equity. So we're using equity here. Here we'll say we're using debt. And we're just looking at the income statement right now. You don't have to worry about the specifics of what this investment is, but let's say it brings in a revenue of, after spending the $30,000, we get $50,000. So on both sides, regardless, it doesn't matter. If we borrow it or if we use our own money, we're going to bring in $50,000 for that period. Okay? Whatever the expenses are, all right, we're looking at a very simplistic income statement here. So it's just revenue minus expenses. That's all we're really concerned about right now. Regardless, we had to spend that $30,000. So that's all we have to worry about, that our expense was the $30,000. Here, we're using our own money. Okay, so minus 30. Okay, so no one cares where the money's coming from. The expense is going to be the same, $30,000. So obviously, we have so far a gross profit of $20,000 on both sides. And right now, you're probably thinking, well, it doesn't really matter if I borrow it or not, right? But this is where you have to start thinking critically and start making decisions in finance of what you want to use. Okay, so tax and interest, this is where it comes into play. Since we used equity on this side, we don't have to worry about interest. We're not making any interest payments on this. We just get to worry about tax. So let's say tax here, we said is 35%, right? So 35% of 20,000, so tax, all right, is 35%. So we're going to subtract, if I'm not mistaken, $7,000. Right? We don't have to worry about interest, so we're just taking out tax. So at the end of the day, our net income is practically going to be, make sure I do my math here, $13,000. Okay, so we spend the $30,000 out of our own pocket. It's no longer with us, but we're hoping that year after year we get to keep making at least the $13,000. Okay. Now let's see what happens if we use debt to finance this. So remember now, the $30,000 we had when we used equity, that's gone. We spent it. That's part of our expenses. It's no longer ours. All we have now to show for our business, if this is the only thing we had a chance to invest in, is this $13,000. We no longer have that $30,000 we started with. That's very important for you to think about, for you to realize, for you to think critically on and actually start trying to digest. We no longer had the $30,000 that's out of our bank account. All we have now is this $13,000, and hopefully we get to duplicate this success time and time again. But let's see what happens when we use debt. So we're at the 20,000 mark, right? But guess what? Now with a 10% interest rate for borrowing the 30,000, we have to take care of interest minus, that's 10% of the 30,000. That'll be 3,000. Jeez, this already looks bad. And then we have to pay tax. This is a lot. This is no fun. 17,000. All right, and then the government is going to say, okay, you have 17,000 left. Now we're going to tax it. We're going to tax the 17,000 at 35%, and 35% of 17,000 is 5,900. Don't be shy to use a calculator. They're your best friends. Okay? So what's left? What do we get to keep in our pocket? 11,100. Ooh, so it looks like, why do people borrow? I don't get it. I mean, at the end of the day, if we use debt, we add more to our expenses. We're paying an extra $3,000, right? We're taking home less, $11,100 to put in our pocket and take home because of that extra interest. Look, if we use equity on loan, we're taking home more, right? In our net income. But that's not the case. Remember here, 30,000 that was in our bank account is gone. Okay, gone. Here, we made less technically, but that $30,000 at the start with, we still kept. So we still have it. Okay, so we still have the $30,000 that we started with, plus the 11,100 that we made. We get to do something else with that money. So this is why you have to think critically about finance and think critically about leverage. I always liked, in my mind, for the way my mind works to process leverage, I like to think of tax as a tax. I'd like to think of interest as a tax deduction. Because we're going to pay our interest and then the government's going to tax us. So if you look at it that way, you have a different relationship with borrowing. So that's why a lot of financial experts do not frown on leverage, because you get to keep the money you have. Yes, you're going to be paying interest, but hopefully you get to be more and more productive, that you could use this 30,000 for something else. You could eventually make the 30,000 with just running the operation that you invested in, and then you get to completely pay off what you borrowed, and you're still making that money. And Lord knows, if you're able to actually use this 30,000 that you keep, you could invest in so many more things. You're not tied up. You haven't tied up all of your equity. You're able to make more decisions. You're able to look into the world and have more choices, because you're not saying, look, this is all I have, I'm dumping it all into one thing. You're able to spread your chances of success. At the same time, you're spreading your chance of risk. But if you are intelligent and you know you're making the best decisions that anyone could possibly make, then leverage is not a bad thing. All right, so it was very important for me to give you an example of how leverage works and how it affects an income statement. Hopefully you get the idea. I'm not making this video so you could champion borrowing money and you decide borrow. No, you have to be, if you decide that you're going to start leveraging, then your level of intelligence and your awareness of your financial setting, it needs to be at the utmost highest, because you're risking so much. All right, because if this goes bad, if borrowing 30,000 goes bad, I mean, you're still going to be on the hook for it. Okay? And you may have decided, hey, I'm going to spend this 30,000 on something else. If that also goes bad, now you lost 60,000 as opposed to just a 30,000. So you have to think critically about your decisions.